Good afternoon, everybody. And Tom, can you hear me okay?
I can.
All right, perfect. So, good afternoon and welcome to our COVID-19 town hall. We're going strong on a couple weeks here. Up on the screen, I just wanted to point out that if you are experiencing audio issues, please use the call-in number provided at the time of registration. And you are muted at this time, so please submit questions if you have any. So here are our speakers for today. We have Kristi Weierbach with Workforce, Phil Keeney for Technology, Tom Mao for Regulatory, Chad Bumbaugh and Steve Snyder covering Cash Flow and the ever so popular PPP, and Katie Boshniak with Human Resources. We also have a guest speaker with us today, Chris Baker from Hillman Consulting, which we will introduce at a later time this afternoon. And just some housekeeping items before I turn it over to the rest of the team. You can customize what you're seeing on the screen right now just by going to the GoToWebinar screen viewer. And all attendees will stay muted throughout the entire presentation today. And so we ask that you submit the questions through the questions pane in the GoToWebinar pop-out that you see there on your screen. And to help us manage the questions as we are getting a bunch of them in, please let them flow into the buckets. So meaning to, label per se for workforce, technology, regulatory, cash flow, and human resources. That just helps us and the presenters, sort through them a little bit better. The slide deck that you are seeing on the screen is available for download in the handout section of the GoToWebinar panel. And if you're experiencing audio issues, once again, please use the dial-in option that coordinates with your registration rather than the computer audio. This just helps with feedback. And all the information we just wanted to point out is based on what we know as of 2:00 p.m. Today, April 21st, 2020, as this remains a fluid situation. And just some next steps for you. Our next town hall is Tuesday, April 28th. Same time, same place, and we will be sending a reminder email out for that. Secondly, please visit our COVID-19 section of the website for additional insight and information. All of our previous town halls are recorded and stored there as well. And if you have any questions that aren't answered either during this presentation or via the survey, please reach out to us on our contact page of the website. Here are the question buckets again, just to remind you as you are submitting questions for our Q&A portion today. And just to look at the agenda, we have an introduction from Tom, and we have regulatory, workforce, cash flow, and PPP forgiveness updates today. Like I mentioned earlier, we do have a guest speaker, Chris Baker, with us from Hillman Consulting. He is going to give us an update on facilities. And then we will have our roundtable portion for the next 30 to 60 days, and as always, our Q&A portion. So without further ado, Tom, I'm going to turn it over to you.
Well, thank you, Kaylee, and thank you all for joining us once again this week. It's hard to believe that it's been, I think, 5 weeks now that we've been doing this, although I have to admit I'm starting to kind of lose count, like I'm sure some of you are. But certainly still lots and lots of information to get in front of you. Kelly's comments about this being a fluid situation couldn't be any more true again this week. I think it was 2 or 3 weeks ago when we presented, I told you I had one eye on a TV beside me and one eye on a Twitter feed to the other side because the Senate was in the midst of passing the CARES Act at that time. Well, as we speak today again, you're probably all aware that we're waiting for the Senate to take some action again today to replenish the PPP fund. So hopefully that's going to happen. Maybe there'll even be agreement before we get off the air today, and we'll see some additional funds. I'm sure all of you are very, very interested in the status of the PPP, whether you were fortunate enough to get funded in the first round or not, or if you have that application ready. We certainly understand there's about $310 billion, hopefully earmarked for the next round, and some other dollars there as well, $60 billion for the emergency injury disaster loans, about $75 billion flowing to our hospitals, especially those in rural areas, and $25 billion for additional testing. So we wait for that, and Steve and Chad are going to have many, many more comments on the PPP program when their update rolls around, and I'm sure you'll have some questions on that as well. We are also, again, still hearing that around 4 or phase 4 is in the works. We're hearing that may focus around assistance to state and local governments, possibly $150 billion or more to go to the emergency service providers and all of those other vital services that do happen at the more local level. So we have a very full agenda for you again, as always today. As Kaylee said, we're going to do some updates with an especially, I think, important section that Chad Bumbaugh is going to walk through on PPP forgiveness. While we may not have formal guidance on that yet, we think we know enough to give you some overview, and we've been getting an awful lot of questions on that. So Chad has a really good presentation with some examples he's going to walk you through today. As Kaylee said, we're more than excited to have Chris Baker from Hillman Consulting with us. I'm going to let Rick Hogentogler do a little bit more formal introduction of Chris later, but please stick with us for that, as well as our roundtable. We started last week with the theme of companies reopening. What does a 30-day, a 60-day, a 90-day plan look like? What are those sort of things that you should have front and center? We concentrated on 30 days last week. We're going to try to move to 60 days this week, but there's a couple more topics that came up as we discussed internally during the week that we think are pretty important in the short term. And I think that's becoming more and more important every day. We are hearing some states actually reopening as early as this coming Friday. I believe Georgia and Tennessee are going to take some of the lead on that. Some of the other states are following in behind, and hopefully it won't be too long before the majority of the states are starting the very slow return to normal. So a lot of items there that we will talk about on that. As I'm talking here, someone just IM'd me that the agreement was just reached. So I hope that's an accurate statement. So good example of how fluid this thing is. I can't even get through my comments here without a change. So, but that's all good news. So we're certainly going to be talking about that. As always, as Kaylee said, please submit your questions. We'll get to as many as we can, either answering them directly back to you as you submit them or in our Q&A section at the end. And those we can't get to, we will certainly be responding through over the rest of the week. As always, keep the communication lines open to us anytime. I know we get a lot of calls, a lot of emails from folks that participate in the town hall after the session's over each week as things come to mind, and we certainly encourage that. We know the week goes by in between sessions quickly, but a lot of things come up that you just really need to have an answer on sooner rather than later, and we try to be very responsive on that. I would also direct you to our website. I've talked about that in the past, a couple of documents that we've put up there. There's been one out there for a while on cash flow. There's been another on steps to manage your business. Another excellent piece was written by Chad last weekend and has been posted on Paycheck Protection Program facts. I encourage you to take a look at that. Chad did a great job of capturing some of the things that we've seen frequently asked in the questions, and I think that'll be a really helpful tool for you. Remember, as Kaylee said, our prior sessions are recorded. They are on demand at the website. Some other webinars on more specific topics that we've done are out there as well. We will be doing a webinar on May 12th, specifically for the AE industry, talking about cash flow boosting activities as it relates around taxes, some of the things you may have overlooked that can put some cash back in your pocket. And I believe that's already advertised at the website. So if you're interested in that, please sign up and join us on that one. As Kaylee also said, we are scheduled to do another town hall next Tuesday, April 28th. That is our last formally scheduled town hall, but if things keep moving as quickly and changes as we've seen, we certainly will continue to schedule these sessions well into the future for as long as necessary. As long as they keep coming out with new information to share, things to interpret, we'll be here to present that to you. So with that, we're going to move into the updates, and actually I'm going to lead off this week. I'm going to go first on the regulatory and tax side. I really don't have a lot of comments this week. I've gone through a lot of provisions over the last couple of weeks of all the new tax provisions, and I'm not going to go into them in detail again this week, but certainly if you have any questions on them, please send them to me. Happy to answer them in the Q&A session. The couple of things I did want to provide updates on, things that did happen since we last talked last Tuesday, is when we were online last week, the stimulus checks, the direct payments to taxpayers were just beginning. They actually started way back on the 10th, but I don't think most people saw their money, if they've seen their money yet, until Tuesday or Wednesday of last week. I know we were hearing from a lot of clients that they saw their money hit their bank accounts last Wednesday. However, we are hearing from an awful lot of people they have not seen their money yet. We understand about 80 million payments have gone out thus far, but it is staggered. If you haven't received it yet, don't panic on that. We do know there are some glitches in the system. The portal to check the status of your payment launched midweek last week, and it's worked really well for some people. I've checked for some clients. It was very clear when the payments were going out. For other clients, I can't explain why they're any different than the ones that it worked for. It's not working. So continue checking that regularly. It's at the IRS website, www.irs.gov. It's just under the stimulus payments, you'll see a link for where's my payment, and you can enter some information. You should have your most recently filed tax return in hand, because it will ask you some questions off of that. Hopefully it works for you. If not, be patient. Keep checking back. They update it once a day overnight, so no need to look at it more than once per day. But in some cases, it may be that they just don't have your direct deposit information. I had a client who clearly, this was a kind of an interesting case. They clearly had their information because they had a balance due on their 2019 return on April 15th. Sure enough, they took money out of their account, but they haven't put any money back in yet. So I know it can be frustrating, but remember, this has been a massive undertaking by the Treasury and the IRS. So we'll keep sharing information as we know it and tips on how you might be able to accelerate your payment. One other item that I talked about last week that was kind of new last week, and I wanted to circle back to it and just emphasize it one more time, because I think it is a cash flow opportunity for all of you. And that is the ability to defer the employer Social Security tax. This is that 6.2% tax that you pay on every dollar of your employee's wages up to the annual limit. In the initial guidance that we received, we were led to understand that if you were participating in the Paycheck Protection Program loans, you could not also elect to delay the Social Security tax. Well, with the FAQ that came out from the IRS last Monday, it clarified that a little bit. You are allowed to do the deferral from the effective date of the CARES Act, which was March the 27th, through the date that you are granted forgiveness on your loan by your lender. Now, as you know, that forgiveness period is 8 weeks from the date that you receive your money. We're not sure how long that forgiveness is going to take. Chad's going to talk about that, but we've seen anything up to 2 months after the 8 weeks are up. So you're potentially looking at delaying payment of your Social Security taxes for maybe as much as 2 to 3 months or more. Depending on the size of your payroll, that can be a fairly significant number. Now, some of the clients I've talked to really aren't interested. They don't want that liability hanging out over their head at December 31st of 2021, and then the other 50% at December 31 of 2022. But others may be looking at it as, another form of, in essence, an interest-free line of credit. Monies that you can keep working for you until they're due to be paid to the IRS anywhere from 18 to 30 months down the road. So it may be advantageous to some, not as desirable to others, but I certainly wanted to make sure that you were aware of that, even if you did take the PPP loan. We've talked at length in prior weeks about the payroll tax credits that revolve around the Families First Coronavirus Act. These are the ones for when you are forced as the employer to pay employees under the Emergency Paid Sick Leave Act or the Emergency Family Medical Leave Act. I think we beat them up pretty good in our past sessions, but I just wanted to let you know that the FAQ, again, at the IRS's website on these programs was expanded further this week. There are now 67 different Q&A out there. It goes into pretty good detail. I've read through it, and I think it covers just about every situation. So if you're wondering, how does this work for me? What is the process of claiming the credit, getting my money? It's a really great resource for you to kind of circle back to. I also wanted to mention, again, something that I talked about last week, and that regards the IRS and their services. Some IRS service centers are shut down completely. Most are running on a skeleton crew. If you're sending paper to the IRS, it may not get dealt with. They are not processing any paper file tax returns right now. They are not corresponding to notices and such that you replied on paper. If you can file electronically or correspond electronically, please do so whenever possible. I mean, we've heard stories that there's tractor trailer loads of correspondence and mailings sitting on the sidelines waiting for the IRS to come back to work. So if you have sent paper to them, again, you're going to need to be very, very patient with that. The last topic I wanted to hit on before I hand it off to Kristi again is, don't forget, there are a number of ways to use tax provisions to generate cash flow. In our May 12th webinar, we're going to dive into a lot of these in more detail. But don't forget, there's new provisions in the law, such as the new net operating loss carryback rules, the more favorable depreciation rules for qualified improvement property, that if you fall in those categories, you can take some quick action. There's something called a quick refund claim if you have a net operating loss carryback, that you can use that to generate dollars quite quickly for you. The big one that I like to talk about all the time, if any of you have ever been on my webinars before, you know you've heard me talk about this over and over and over again, but we still run into on almost a daily basis companies that are not taking advantage of the research and development tax credit. When we get into the roundtable, we're going to talk a little bit more about the R&D credit and how it can be utilized as you reopen your companies, reopen your firms, and make adaptations to what's going to be, I think, the new normal in our working environment. But don't forget the credit is available for prior years as well. If you have not claimed the credit before and you have qualifying activities, you may be able to go back as far as your 2016 tax return. A couple of weeks ago, we were probably saying 2017, but with the extended due dates, we now can file amended returns for 2016 up to July 15th of this year. If you have qualifying activities, you just need to get that study performed, get amended tax returns in, and generate some cash rather quickly. We see the R&D credit being applicable to many industries. We do a lot of studies in the architecture, engineering, and construction arena. We also do quite a few in the manufacturing arena. We're doing them for technology companies. Those folks are developing new software and new apps. We don't do so many of these, but we know it certainly is available if you're in the agricultural world, and you're putting in new processes and new procedures to make yourself more efficient. Really, really a good source of some cash, and please don't overlook that. And then last but not least, maybe for more of a defensive strategy, I just posted some information internally to our firm today. As the states and local governments get back to normal and we get through this, they are going to have some extreme budget crisis. And we believe the trend that you're going to see is some very, very strong enforcement at the state and local level of currently existing taxes, maybe the introduction of new taxes, maybe more audit activity. And while that certainly sounds like a negative, and I suppose it is, there are a lot of ways to plan around state and local taxes based on the fact that there's not a lot of uniformity from one state to the other. So if you are a multi-state entity, you're shipping your product to more than one state, you're performing projects in more than one state, you're going out and you're installing, don't overlook state and local taxes. We don't want you to have a bad surprise on the back end. These are all things that we're happy to answer your questions, consult with you with. and help you along the way on that. So that concludes my comments today on the regulatory side. So I'm going to go ahead and kick it over to Kristi, who's going to do her update on workforce.
Good afternoon, everyone. So I only have a few things to talk about today, very brief, but you will see me again, as Tom mentioned, in the round table discussion. So I'm not sure if you've looked at the Department of Labor FAQs recently, but they did on Monday put a few more to the end of the list, so now we're over 80, and included in there is additional guidance on how to calculate regular rate of pay, and also they did a nice job of categorizing the questions for us. So category, we click on it, and then it takes us directly to those specific questions. So check that out when you have an opportunity. We've shared the link before, but if you do need it again, please let us know, and we'll be happy to share that with you. From an unemployment standpoint, if you're in Pennsylvania, good news. Those individuals who are considered self-employed, gig workers, etc., you now have access to the new online portal. But as with anything, any new technology, there are sometimes little bugs or kinks that have to be worked out. So be patient, but there is hope on the horizon for individuals to receive unemployment who maybe normally wouldn't have been eligible, but due to COVID-19, now you can apply and receive at least some benefits. So I do know that in Pennsylvania as well, the federal unemployment portion has started to make its way to some bank accounts, not all, so we will see that continue to wave, I believe, into individuals who are collecting unemployment. They'll see that in their accounts. And again, just be patient. It was a lot of activity put on the system in a very short period of time. So there is hope. It's coming. And if you're not in Pennsylvania, what I would recommend is to stay connected to your state website for unemployment, Department of Labor, and so forth, because you should be seeing regular updates, especially if you have a system that's being updated like ours was in Pennsylvania. So as Tom had discussed, he said, it's going to be a slow return to work, and we will see that. It's evident with the plans to recovery that the different states and the federal government have outlined or continue to define for us. So one of the things that you will be challenged with is deciding, okay, I got the PPP loan. Do I have employees get paid under that? Do I allow them to continue to collect unemployment? Do I pay them paid sick leave? So those three areas will continue to be a challenge for all of us. This session is definitely not long enough for us to take a deep dive on that. But one bit of advice that I've spoken to in the past, and to some of you who are currently on with us, is if paid sick leave qualifies, if your employees have criteria to meet that, then absolutely pay them the paid sick leave. You get 100% of the value of those wages as a payroll tax credit. So there should be no expense to your bottom line unless you pay them up and beyond those daily limits. And for that payroll tax credit that you receive, those wages, you don't pay any employer Social Security tax on that. So if you pay wages with the PPP money, then you will pay those FICA taxes on those earnings that you're paying out. So just take that into consideration, just like Tom talked, where you can defer that money. You also could save yourself a little bit of cash by not paying the FICA taxes on the paid sick leave and extended FMLA. So keep that in mind. There is going to be a lot of fear, uncertainty, just anxiousness about employees coming back to work. I receive phone calls on a daily basis about employees just being scared. They don't want to come back. They're not ready to come back. And so companies are challenged with trying to balance workload, bringing employees back, trying to be caring and compassionate, and then also, saying, look, you have to come back. We can't continue to pay you while you're off. We need you to work and so forth. So that is a hint of what we're going to be talking about in the roundtable, a little bit more about, what do we do now that we're bringing employees back to work, and what does that look like? We touched on it last week, but there's definitely additional insights and thoughts that we have had since, and we will be sharing those with you shortly. So I am getting ready to hand it over to Steve. Are you ready to take the baton?
I am ready. Thank you.
Great. He's going to be talking about cash flow and go ahead.
All right. I'm ready. I even found my unmute button, so I'm prepared. So I wanted to talk about a few things. On the call, we have a number of architect and engineering firms who have been sending in questions related to FAR. And I know this isn't going to really impact everybody on the call, so I'll try to keep this brief, but I thought it was important enough to go over this as it impacts some of these overhead rates. Just this week, the DoD, through Secretary of Defense, put out an FAQ that addressed some of these costs that companies are going to incur related to the COVID crisis, that they are receiving funds from the PPP to offset. So essentially what they've said is that for any funds that are received through the PPP, these will be a deduction to eligible costs when calculating your overhead rate. Now that also means that, and they said this is regardless of forgiveness. The FAR has a section in there that talks about your total direct and indirect costs are allocable to a contract less any credits, allocable credits. This loan in totality is considered a credit. So that would be an offset to your indirect costs when determining your rate. Sounds a little over the top, considering that you still have to pay back any unforgiven pieces. And there's some conflicting information, of course, within the FAR, because essentially the government wants you to maintain your employee workforce. They want you to be able to meet their needs from a contract basis. So having everybody available and ready to work is very important to them. To do that, you got to pay them even if there's no contracts to be working on. So what we're thinking in this regards is that if you are able to substantiate these payroll costs related to employees that you're paying, make sure you're documenting everything. We don't know what each state, DOT or other agencies may want to, or how they want to treat this. So we just encourage you to document, have your people document in their time sheets what they're doing to help the business when it's an indirect during this period, this 8-week period. We just know that the government wants you to maintain your employees. It costs more for you to go out and rehire them or hire new people to replace them and to retrain them, so that when this thing breaks and you're actually allowed to go back and work on these projects, you got to be ready to go. So it's very important that you track all this time and document it well, so that you can support your position in the future when you file for your overhead rate next year. That's about it on the FAR side of things. I hope I kept that quick enough and didn't bore everybody else. Some additional things I wanted to talk about are the PPP loan documents. We're starting to see some of those come out. Everybody's so anxious to get their money. Most people aren't even looking or reading through the documents in totality. They're just signing, giving me my money, and running. Pay attention to some of the language in there. We've heard stories that there's language in regard that's conflicting with other loans that you currently have. There's conflicting language as it relates to collateral, right? These loans do not have to be collateralized, but there were certain banks that were using their own documents for loan documents, which maybe already have that language in there. There's subordination clauses on your other loans that you may have, whereas it might say you can't prepay any other debt, whereas this offers you a great opportunity to repay early if need be. So make sure that you're talking to your bank as you read through those loan documents and looking for that type of language. This is such an extenuating circumstance. More likely than not, you won't have any problems getting around that, but it's best to talk about it up front. And I wanted to talk about the status of the PPP funding. As you know, or may have heard, there's been $1.6 million or 1.6 million loans granted in the first round. I say first round because, as Tom mentioned, that supposedly we have another package that just got approved. 1.2 million of these loans were for $150,000 or less. So a lot of small businesses did actually get to benefit from this instead of the larger ones. All the funds were accounted for by April 16th. So that's 13 days. They went through almost $350 billion. Average loan size ended up to be about $206,000. And I said about 1.6 million loans were granted. It's estimated that there's 30 million potential qualifying businesses. So that's just a small portion and why we need this additional package so much. And this new package is supposed to, I think what I heard is going to be $310 billion. That's probably not even going to be enough for the remaining companies. Top 5 states that received these funds: California, Texas, New York, Florida, and Illinois. Pennsylvania was a close 6th. Top 5 industries: construction, the professional, scientific, technical services were number 2, manufacturing, then healthcare and social assistance, and then accommodation and food services. A little surprised that was number 5. I would have thought that would have been higher, but it is what it is. And then retail came in at number 6. So Tom mentioned that the Senate got the bill in front of them, and I guess they passed that supposedly. So we'll see what comes of that. I don't know if we'll have time to talk about that today or not. But that's just a quick run through of what I wanted to talk about today. I'll be back again later on the roundtable panel to talk about the future and some other cash flow considerations. But for now, I'm going to pass this off to Chad. Chad, you ready?
Yes, sir. Thank you, Steve. Just 1 or 2 quick comments to add on to what Steve said about some of the loan programs. One of the things that I am seeing and hearing some questions on is, what happens to my application with this round 2? Am I going to stay in the queue with my current bank? Should I move to another lender? Or how should I handle this situation? And the suggestion that we have is, if you're not comfortable with the current lender and how they've handled your situation, this might be a good opportunity to pursue some other courses of action. I had an individual share with me this week that they actually jumped to a different bank and were approved the same day for the pending status on round 2. So definitely think about that. Also, in regards to the loan documents, something I wanted to mention is the verbiage should basically say that the rules of the loan is going to be governed by the SBA. So the SBA documents and what we're going to see on forgiveness will ultimately provide you with the rules of the loan. And that's going to give you the idea and the framework of how that forgiveness works. So that's what we'll really want to see in those loan documents, even if there is conflicting information, that you look to see if it is to be governed by the SBA docs. So something else on that front is, and I don't know if it made it into the agreement that was reached here just a couple minutes ago on round 2 of the PPP funding, but I did see a senator had asked to make an amendment to the act that will require banks to process these applications on a first in, first out basis, regardless of, if you have an existing relationship with the bank or the extent of that relationship. Again, I thought that was a nice addition in regards to just some of the news stories that we're hearing about, how these funds got processed the first time and some of the headlines that you've read about some of the larger companies getting loans. So I don't know if that made it in there or not, but hopefully that would level the playing field if there were some things going on that really weren't as desired with the first round. So just wanted to mention those couple things before I get into the loan forgiveness. And also wanted to add that we mentioned last week the Main Street Loan Program. So this is the Federal Reserve program that was announced about loans for entities up to $10,000. That program still has not yet been finalized, but my understanding was a comment period closed, I think it was the 16th of last week. So I would expect if you're interested in that program that we may be hearing some more details in the near term about what that looks like, if you're interested in the non-forgivable Main Street Loan Program. So I just want to mention that you may see some more information there. So what I'm going to move to now is, I think one of the things that we've gotten, quite a few questions each of the last few weeks about forgiveness, and we keep hoping that this is the week that we're going to see, the formal guidance come out. But I think what ended up happening is, round two of the stimulus funds were needed, and that diverted a lot of the attention of the Treasury and the legislators working on these things. So we have not yet seen the forgiveness final documents. So I'm going to walk you through the best that we can right now. I'm going to add some interpretations that we've made. And Kayla, if you want to go ahead and advance the slide to the disclaimer, and I won't bore everybody with the full verbiage of this, but you can refer back to it. We're taking our best guess and our best interpretation of a lot of different readings on the guidance with what we're going to share today. So please don't take this as the gospel. But we thought it'd be very helpful to walk through the mechanics to give everybody a little bit better understanding on how this forgiveness is likely going to play out based on what we know today. Now, again, the final rules may change this, and some of these changes may be significant, but we wanted to at least let everybody see how the mechanics work and look through a couple examples of the process at this point in time. So, if you don't mind, go ahead and advance the slide. I'm going to start with just a quick reminder of kind of what this program's about. I know a lot of folks have already applied, and a large majority have gotten funding to date. So that's great. So what we're looking at is up to a potential 100% forgivable loan, including any accrued interest during this 8-week period. And that forgiveness is determined based on how the funds are spent in that 8-week period. And it's important to note that the expenses that qualify or that are used to determine forgiveness are based on those that are incurred and paid. The emphasis on the word "and" there during that 8-week period to be eligible. And this is something that is really the first item that's caused a lot of debate is that "and" to me, and I think the majority of the folks I've talked to has implied that expenses have to be incurred once the loan was obtained and paid, meaning that this essentially puts things on the cash basis. So we can't accrue for items and have them count toward the forgiveness. We also can't pay rent from prior months or pay payroll from prior periods and have them count towards the forgiveness. The key word is incurred and paid. Now, again, this may change in the guidance, but that's how we're reading and seeing, what that means today. The 8-week covered period, the start date of this begins when the PPP funds are received. So for many folks, that clock has just started or is just about to start. And then the forgiveness is subject to various determinants that are measured throughout the 8-week covered period. And we're going to walk through some of these. We're going to walk through how we see these items interacting throughout this presentation, and again, give you our opinion on what this looks like. And then ultimately, the lenders are going to be the forgiveness determinations. They're going to make those and work with the SBA on the back end of this loan to determine what are the amount of loan that is required to be repaid and what the amount is that can be forgiven at that point in time. So the other thing I'll note before we jump on to the next slide is I included some asterisks throughout the presentation to cite, where we are looking at for the predominant guidance for what we're pulling into this presentation. Thought that might be helpful for some folks if you refer back to this later and want to see why we included or why we're taking the position that we have. So those aspects will point you back to the specific guidance where that verbiage is contained. So that's what the asterisk is at the bottom. The last thing I'll add is related to the incurred and paid comment, and I want to mention this before I forget. Related to retirement contributions, this is one of the other top questions that we've received, and what about our 2009 retirement contributions that maybe we haven't funded yet? The 2019 tax return isn't going to be due if you extend it until September 15th for pass-through entities, October 15th for C Corps. Unfortunately, the way we read the incurred and paid guidance is those costs for the 2019 retirement plan cannot be claimed as forgivable. But what we're thinking, and this is again is where we're making some interpretations, is if you historically have only paid your retirement match annually, you could quantify the amount that was earned by your employees during the 8-week period and fund that and have that be eligible. Now, again, do you want to go through the exercise and go through the mechanics of doing that? You may or may not. but I conferred with some of our folks that do the employee benefit plan audits, and generally the DOL is never going to get upset if you give folks money a little early, if you give it late. So we're thinking that may be an avenue that you want to look into if you're close on some of your metrics in regards to forgiveness. So I just wanted to mention that one before I got too deep into the weeds. So what I want to also cover now is with that foundation laid is some more of the details of the forgiveness and what is included as covered expenses. And this is U.S.-based cash compensation up to $100,000. Well, what's cash-based comp? Have a list there: wages, salaries, commissions, bonuses, leave time, etc. As long as it wasn't claimed as a credit under any of the other programs. So if you're out of pocket, the employer's dollars that aren't subsidized in terms of compensation, that it would hit a W-2. That's the type of things that are cash-based compensation. That's limited to $100,000 per individual. Group health care benefits, including self-insurance and retirement benefits, are also eligible for eligible payroll costs. Those are added on top of the $100,000. The employer paid state and local payroll taxes. So think if you have unemployment taxes in your state on the wages that the employer pays, those are the types of things included there. Rent and utilities if the lease or the service is in place before February 15th, 2020. And then also mortgage and other interest for debt that's in place before February 15th, 2020. Now, a couple of things I want to call out here is on the rent, related party rentals are not specifically disallowed in the guidance anywhere to date. But it is important that you have the rent agreement in place prior to February 15th. Or else we could see the fact that those rent payments may be challenged upon the forgiveness. So it's probably good if you don't have a rental agreement handy and you don't know where it might be to dust off the files and see if you have one in place if you're claiming the rent as part of your forgiveness calculations, or talk to your lender if they'll take something else in the absence of the formal legal document for the lease agreement for those related party rentals. As we interpret it, rent also includes things like vehicle leases, equipment leases, software leases, as it is not specific to space lease. It seems to be just rents or leases. A couple things on utilities that I'll clarify. The Act defines those as I've listed there: electric, gas, water, water, transportation, telephone, internet. We're assuming things like sewer and trash would also be included in that. Again, that's interpretative, not in the guidance at this point. So we're not 100% sure, but just seems to follow the logic. And that transportation question, Mark, is, well, what are they referring to? And the best we can tell there is they're looking at the transportation utility as being fuel used for business vehicles. So again, that's an interpretation on that guidance, but I really don't know what else they would mean by a transportation utility per se. And lastly, on this slide, the mortgage and other interest. There's been a little bit of debate about how this was worded and some of the regulations, the CARES Act itself, the interim final rule, things like that. It was a little bit conflicting in terms of does the loan need to be secured by a mortgage or not? And what we're reading and how we're really interpreting this is that the intent is that it's really any existing debt obligation that's in place by February 15th. Not necessarily those secured by a mortgage. So we think that as long as it's in place, that it's eligible. I did get a question this week. What if we have an existing loan that because of the favorable interest rates, we decide to refinance after the cover period? And again, this is pure opinion on my part and a couple of colleagues that we bounced the idea around. And we're thinking that you can prove that the debt was in existence. And in essence, you're refinancing to a cheaper cost of funds. So as long as you're not taking on any new principal, we think likely that you may be able to justify claiming that interest on the new debt as part of your forgiveness. In essence, you would be paying at a lower cost, a lower rate. So if anything, it may actually hurt your forgiveness, but we do think you can make a case that it would be allowable for the calculation. Again, that is an opinion. So if you want to go ahead and advance the slide, that's kind of meant to set the framework. And I know that, I kind of jokingly called this a basic walkthrough, but really, there's a lot of nuances and mechanics to this to even a basic example. So I'm going to move now from the 10,000 feet down to really what the determinants look like for the loan forgiveness. What are the things that have to happen or have an impact on the amount of forgiveness that are incurred? So the first one of those is the 75%, 25% usage requirement. And the Treasury made it clear that they want to see 75% of these proceeds used for payroll costs. And that includes the actual cash compensation, the health benefits, retirement, and the other items we had talked about on the previous slides. And then the other percentage, the 25%, is for the other items: rent, utilities, mortgage, interest, and other matters of that nature. So this is a payroll program. The name of the fund is Paycheck Protection Program. So again, it's really payroll based, and that's why they're looking to have the 75% of this be related to payroll. So that's the first hurdle that businesses have to clear when you look at the forgiveness, is that split. The next two really operate sort of together. I don't think there's a certain order on these two, but I'm going to cover the FTE requirements first, and that means that if you reduce your headcount after receiving a PPP loan, you may be required to reduce your forgiveness percentage. And we're going to walk through an example of that in just a minute with some scenarios. And the other question that we're receiving quite often is, well, how is FTE defined? I'm not sure. When I did my application, I had to provide a number that was called headcount. How does this all interplay? And we're looking at FTE, and from everything that we're seeing, is it's defined as an employee working over 30 hours per week. This is called the ACA method, and I have cited there the ACA methods where it is in the IRC, the revenue code. But with a little twist, what we're seeing is that instead of it being measured monthly, just purely monthly, that it's based on the amount of employees per pay period on the month averaged. So it's a little bit different than the pure ACA method. So it may require you to track FTEs on a per pay period basis. Now, if that was intentional in the wording or just kind of a wording slip, we're not 100% sure. And we're hoping that we see the definitive guidance there is also, firmed up definition of the FTE calculations, because they're so important in this process. The next item then is compensation requirements during the 8-week covered period. We cannot reduce compensation by more than 25% per employee during the covered period, and this is compared to the most recent full quarter during which the employee was employed prior to the covered period. And I have to pause every time I say that because it's a mouthful and I almost confuse myself. But as an example is, if we got the PPP loans today, April 21st, the most recent quarter is the first quarter of 2020. So we would be benchmarking the compensation paid during the 8-week period against the first quarter. And we're going to walk through an example of this momentarily as well. And a key thought is, or a key thing here to note is, this requirement applies only to employees that are under the $100,000 wage cap. Now, interestingly enough, that wage cap is not interpreted to be annual. In this case, it's meant to be on a per pay basis, so it's annualized. And we'll talk about that a little bit in terms of the example as well. So that's kind of the determinants of how this product works. And I really view it, if you think about it, like a faucet, and the water coming out at the top of the faucet, and then you have a cylinder where you're going to potentially capture some of the water, weed out some of the items that are in the water, and then you have another cylinder under that, and you have a little bit of potential forgiveness getting trapped in each of those categories. And then at the ultimate, you have at the bottom of that waterfall your loan forgiveness. So I've been thinking about it that way to help me rationalize and think through this process, and you'll see at the back end we have a little bit of a summary that covers it in that manner. So if we want to move to the next slide, what we're going to do is we're going to talk about one of the buts in this law, and that is the ability to have the 8-week any shortfalls in employee headcount for the FTE and salary forgiven by restoring those by June 30th. And what that means essentially is they're not going to reduce your forgiveness if you essentially remedy any reductions at headcount or salary by June 30th. So if you would otherwise have calculated a reduction in headcount or wages through actions taken by April 26th, you can remedy that by restoring the individuals and the compensation by June 30th. So that's the grace period. That April 26th date was 30 days after the enactment of the CARES Act. So that was where that date came from. It wasn't just pulled from thin air, although it may seem like it. So we're going to walk through this restoration period, and there's a lot of questions really related to, is this only helpful potentially, or if I start at my 8-week period, and let's just say I get to the end of it and I'm out of PPP funds, cash flow's tight, and things just haven't picked up. We don't have the volume that we once did. We're not having a need to have all of our employees on staff. What if I let somebody go in week 9 or week 10 and it's before June 30th? Do I have to measure to the number of employees at June 30th, and can it hurt me? Or is my 8-week, the full-time equivalent and salary limit only relevant during the 8-week period that the PPP costs are potentially forgiven? So there's a lot of questions around just how exactly this June 30th date is going to work. Personally, I read it as it's a restoration. It's meant to be a way to cure some of the issues. So I think it's only intended to help you. But again, I'm getting inside the minds of the folks that are writing the law, and I'd like to let them write the final rules, but I'm going to give you my best interpretation. So I think those are most of the background. And again, if we move to the next slide, we'll walk through a little bit of that. If you think about the water coming out of the faucet, how this flows, and there is some debate about the ordering, because it can have a mathematical impact on the equation and the result. And our opinion is basically you apply the 75-25 rule first to see if the maximum forgiveness is going to be going to meet the criteria for the 75% to be payroll. And then we would look to see, okay, have any reductions in our headcount or FTEs up through April 26th? Have they been restored by June 30th? If yes, we really don't need to go any further because we've kind of gotten it out for those other limitations. But if we have not, then we would look at the FTEs over the 8-week period and also the salary limitations to determine if we have any limitations on the forgiveness amount. So again, that's our interpretation, our opinion. I've seen it in a couple different manners in terms of the ordering. But again, that's kind of where I landed personally is in this manner after doing quite a bit of reading. So now what I'm going to try to do is kind of with that hopefully foundation laid, and I apologize if I lost anybody along the way. It's pretty complicated. Sometimes I get lost myself working through it. I'm going to walk down through and put some numbers and some scenarios to this in the hopes that will help provide a better understanding. So if we can move to the next slide, we're going to start with the 75-25% rule. And what I have here on the left is an example where we have a business that took out a PPP loan of $206,000, and that just happens to be the average loan size that the Treasury said was granted through the first round of PPP funds. So the company on the left with the green payroll percentage, you can see they're at 87.38 utilization for payroll costs. They would be eligible for full forgiveness. There would be no limitation based on this initial cut at the loan usage. The business on the right with the red, maybe they have a larger facility, their rent was a little bit larger, their payroll was just under the 75%. So they would need to have their maximum potential forgiveness reduced. The other thing that I want to say is, just to kind of frame this up, this example assumes that the full 206 is spent during the 8-week period. There is no specific requirement saying you have to spend it, but just for the simple fact of making the illustrations a little bit easier, we're going to assume that it was all received and spent within the 8-week period, just to keep that a little easier. So on the red and the green both, potentially, there may be, well, really on the red, you would have to look to see the other factors if there are further limitations on the forgiveness. Something I'm not sure how many individuals, businesses it's going to impact, but if you did have an EIDL loan that was in place and that was refinanced into the Paycheck Protection Program, that loan is not factored into this calculation, the existing EIDL loan. That's just basically thrown out. It's not relevant to this calculation. Only the actual expenses during the 8-week period are, not the EIDL proceeds. So that's a little bit on the 75-25% test and how that works through the system. So next we're gonna go back to the June 30th grace period, and we're gonna hit on a couple things. If we move the slide to the next slide, we're going to talk a little bit about some considerations around the mechanics of this FTE and what does this look like in terms of the grace period. And the first question is, was our FTE reduction mitigated by June 30th? And there's really a lot to consider here when you think about the number of levers and dials that you may need to adjust and manage in terms of your workforce, in terms of how this works. And who and how they're brought back have a tremendous impact potentially on your amount of forgiveness. And I've walked through a couple of examples here just to try to illustrate how that impacts the forgiveness. So if we think about the core, the most basic situation is that an employee working 30 hours is going to be 1 FTE. If you have that same employee and they're working 40 or 60 hours, there's still only 1 FTE. You don't get any credit for those additional hours. Although if you're paying them additional for their additional hours, it may be a benefit to the salary calculation for forgiveness, but basically that is still 1 employee. If you contrast that with 2 individuals working 30 hours each, the same 60 hours, for example, is number 2, that scenario works out to 2 individuals. So you've got 2 full-time individuals working 30 each, and if you would staff a little bit differently and bring back part-time employees, so you have 4 part-timers working 15 hours each. Again, that's also 2 employees under the FTE calc rules. And then if you go to the extreme and bring somebody back just for a couple hours a week, maybe this is somebody that does some clerical work or something like that, there just isn't the same volume as there is when we have a physical office that's open. Maybe they're coming back 10 hours a week, doing some things, and that works out to roughly a third of an FTE. So again, you've got to think about how and what category of worker we have and how we want to bring those folks back if we're having any questions about restoring the FTE count. So really, what that means is the importance of scheduling, which is already a crucial consideration in many industries. The impact of that just ramped up significantly because now all of a sudden the ability to get this loan forgiven is directly impacted by how we schedule the people that we have. There's also some choices and considerations around the FTE measurement periods, and as well as seasonal business considerations. Just in the sake of time, I'm going to skip over those. But just know if you're in any of those industries that are highly seasonal, you may have some additional considerations. And there's 1 or 2 other nuanced tweaks around the FTE measurement, but I'm going to try to keep it, to the most common scenario. And some of the questions that we've gotten thus far around this is, can I hire family members? If they weren't on the payroll before, am I required to have them be on the payroll before, or can I bring them on and have them help me out with the business? What about temps? What about new hires or rehires into a new or modified position? Maybe one position just isn't relevant any longer until we're back to normal operations, but within that person could contribute over here. Is that going to have any unintentional or negative impact on those calculations? And what if we have somebody that, as Kristi mentioned, just isn't comfortable coming back? So they aren't planning to return to work. And how does that factor in? We think essentially this looks not necessarily to the employee, but basically to the workforce. But again, that's not 100% clear on how that's going to look in the terms of the forgiveness on the back end, because some of these requirements do require you to look to the employee. So it's a little bit different depending on what you're looking at in terms of how you should treat it. So if I haven't lost everybody yet, we're going to go ahead and we're going to advance the slide, and we're going to walk through a little bit of an example on the FTE calculations. And we're going to start first at the headcount restoration, and we're going to look at that as of the date of February 15th, and that's really the line in the sand in regards to when COVID started to become major issue here that ultimately led to the CARES Act and the other provisions. So we look at the headcount on that date. That's kind of your baseline. And in this scenario, this is a 65 employer business. And then by June 30th, they're back up to 45 employees. And it's obvious they've not met the restoration. So now we need to look at the limitation based on the FTE counts during that 8-week period. So we're going to proceed to that next calculation. So what we're going to look at first is, what was our average monthly FTE calculation during the 8-week period? And that's calculated using the ACA method, as I mentioned earlier. 37 employees is what that worked out to in this scenario. And then we're going to look at the average monthly FTE count. In this case, I use 1/1 to 229, and that's item B, and that's 59 employees. Employers do have a couple of choices here on the FTE count that serves as the denominator in this equation. Again, for the sake of time, I'm not going to get into all those details, but there are 1 or 2 other metrics that you can use, including looking back to 19 for a certain period, if that's more representative. And then what we do is we take that percentage, that forgiveness percentage, and multiply it by the total of the loan. So in this case, 62% times that same 206,000. That allows a maximum forgiveness of 129,186. And again, essentially, the assumption at the bottom there is that this business has already met the 75% payroll requirement. So there's no reduction in the initial forgiveness. We're at the full 206 that carries into this calculation. So that's the maximum forgiveness that we're looking at, which is then subject to the salary limitations, which we're going to talk about in just a minute. So if we move to the next slide, what I'm going to share now is how the salary limitation interacts with the June 30th grace period. So if you can go ahead and advance that forward to the next slide, the question is going to be essentially, did we mitigate the salary reductions to any staff? So maybe we had to have across-the-board cuts in our payroll to firm up cash flow for a period of time, and how does that work? And so, it's important to note that this is an employee-specific calculation. So for larger employees, this is going to require a little bit of work. The cap does apply only to employees under 100,000, the annualized compensation cap, and I'll get into that in the example. And an important consideration that I think warrants just a pause here is, as written, the guidance is comparing a quarter. In this case, Q1 2020. So we're comparing the 8-week wages back to the most recent quarter. So if you think about it, comparing an 8-week period to a 12-week period, we're already 33% shorter than the base period. So inherently, there's going to be a reduction of greater than 25% in wages unless pay is increased. And we really think that's just a flaw in the wording that was used to write the act in the haste to get something out there. So we're hoping that gets corrected, because really we think it could have some unintended consequences in terms of what you do with compensation to try to manage to forgiveness even more than some of the things that are already there strategy-wise. So we're hoping that gets cleaned up and we put that on more of an apples-to-apples basis. In my mind, if they just insert the word average there into the quarterly calculation, I think it really makes it much more apples to apples. So I think it's an easy fix as long as it gets worked into the guidance. So the other thing at the bottom of the slide here I just included is some key thresholds, and these are important for your payroll team to keep in mind as they're looking at the compensation that's paid. That annual comp limit's 100,000. So if you break that down into some common pay periods, 52, 26, 24, and 12, you'll see there the amounts per pay period that kind of alert you to when somebody trips that 100,000 annual compensation cap for this metric. So if you're paying bonuses or irregular wages, keep those numbers in mind, as it is on an annualized basis that 100,000 applies. So that covers the background of the salary. I'm going to now move into an example, and I'm hoping this is going to come across okay on the slide. I apologize if it's a little bit small. I believe we'll make the handouts available if folks want to download and look at those a little closer. But what I did here is I put on 6 different scenarios to try to walk through what this means. The first 3 are all the same. Well, really, the first 5 are all the same individual. Let's just pretend they're $1,000 a week, $52,000 a year. It was nice, easy math for me. So we look at in column 1 there, the 3/31/2020 date. That's the most recent quarter. Column 2 was their compensation through the loan receipt date. So the 4/16 in this scenario is when the PPP funds were received. And then column 3, June 11th, is the end of the 8-week cover period. So this is all 3 of those dates, and the compensation for the year to date through them are important in this calculation. If you working left to right on my calculation, you'll next see the 8-week cover period compensation, and that's solely the 6/11 compensation minus the April 16th. So 22,000 minus 14,000 is 8 weeks. So that's our compensation during this period, the 8-week cover period. And then what I'm going to measure is I'm going to measure the compensation for the first quarter minus the 8-week cover period and calculate the shortfall. In this case, example 1, if we paid the person the exact same amount per week, $1,000 a week, for the 8-week period, we're under by $4,000 versus the base quarter. That's a 33% reduction, and then that works out to a $1,000 reduction in forgiveness. And the math is down there at number 4. You'll see what we do is we take 25% of the $12,000. That means $3,000 is the max reduction. And then you compare that to the $4,000 actual reduction, and that delta, the $4,000 minus the $3,000, ends up being your $1,000 reduction in forgiveness. So that's what happens if you would do nothing but just keep paying the person the same amount. You would lose a little bit of your forgiveness. Now, walking through the next 2 examples, these just model what if we reduce somebody's compensation by, say, 12.5%, and what if we reduce it by a third, 33.33. I won't bore everybody by going through all those details again, other than to show you on the far right, the reduction amount does increase as the reduction in their compensation goes down. So example 4 is a regular compensation. So this is somebody that doesn't get consistent compensation. So maybe this is somebody that gets commissions, or they're based on production compensation, or maybe they get some type of a quarterly bonus. So their pay is not as even, as consistent as the earlier examples. So here in this case, they made $11,000 during the 8-week period. Their reduction was $1,000. That as a percentage of the base is 8.33%. So you'll see on the far right, they have no reduction in forgiveness attributable to that employee. They're within the 25% threshold. Excuse me. The next example is, let's just say we're paying hazard pay to employees, or some other form of compensation for the individuals that are coming in throughout this period. And that's a 20% on top of the normal base. So in this case, again, they have no reduction because their 8-week compensation is only 20% less than the first quarter. So again, they met the 25% threshold. And then in the last example, we have an individual that's had $120,000 compensation. So they're over the $100,000 wage cap. And as you can see on the right, even though if we keep paying them the exact same amount per month and their reduction is 33%, there's no reduction in the forgiveness amount for that individual. It does not apply to those over 100. I think the thinking there is that those folks that are the higher earners of a business, if we take them under the $100,000 threshold, in theory to conserve cash to pay others, I think they're trying to encourage that behavior. Excuse me. So the other comment I want to make here that I have an asterisk on there is, this is over 100,000 annualized. This is based on the monthly pay periods at any point during 19. So if you had somebody that started right at the end of the year that was, compensated by, a monthly amount that would result in more than 100,000, they would also be exempted, as would anybody that's getting bonuses or other compensation that put them over the thresholds on a per period pay basis. So again, that's that's probably the most complex it's going to get. Hopefully everybody's was able to stick through at least some of that. What I'm going to do now is I'm going to move to the bonuses and how this works into the calculation. So it's math gets a little easier, I think. Well, what if I want to pay somebody a bonus? I mentioned the hazard bonuses, or what if I usually pay bonuses at the end of the year based on performance? And maybe I want to look at accelerating those to get some of that in the 8-week base period. Those bonuses were in our average payroll from the prior year, and they were factored into the loan amount that was given. But if I don't normally pay them in this time of the year, I'm kind of inherently going to have a reduction in salary as well. So there's nothing that prohibits you from paying bonuses and having them count toward allowable payroll costs, but there are limitations. And essentially, the bonuses can't exceed $100,000 on an annualized basis for determining forgiveness. And what you'll see there is an individual with a $4,000 monthly base getting a hazard bonus. The example on the left keeps them under 12,000, or keeps them under, 100,000, and the example on the right puts them over 100,000. So again, if I paid that person a $4,000 bonus, I'm fine. If I paid them $5,000, I'm over. So maybe what I want to do is, instead of paying one bonus $5,000, maybe I want to try to pay it $25,000 and $25,000 over 2 months and keep them under the threshold during that 8-week period, so that they're under that cap, so that all counts toward the forgiveness. Again, this is where some of the strategy and the planning really comes into play. So if we can advance the slide, I'm just going to walk down through that waterfall of the forgiveness, using the assumptions that we used for this exercise. So the total loan is the $206,000. We met the 75-25% test, so there's no reduction in forgiveness. You'll see then we had a $76,000 reduction in the full-time equivalent count. And also we came up with a reduction in forgiveness of the $6,000 based on the salary that was paid. So our total forgiveness results in $123,186. The percentage forgiveness, and remember this is just more informational than anything, is 59.8%. So roughly 60% of the loan gets forgiven. And then that residual, the $82,000, converts into a 1% loan payable over 2 years with 6 months of no interest, no payments. And you'll see in my asterisk there, I did exclude accrued interest just for the purpose of making the math easy, as easy as I could. I excluded the accrued interest, but there would be a little bit of additional amounts there for the accrual of the 1% during that period. So that is forgiveness. My attempt to make it as easy as possible. I apologize if I failed in that. And we're hoping that there is more finality the next time we talk forgiveness. We shall see. But I'm going to close with a couple slides here. Less math and just more suggestions for preparing for forgiveness. And just to kind of reiterate some of the key points, schedule with intentionality. We suggest that you look at the FTE period and what you're going to need to know in terms of the employee counts. And some of those you can start calculating now. The prior year data, the information from earlier in 2020, we suggest you go ahead and get those numbers locked in now, before you start bringing folks back, or before you get any busier with things opening up, hopefully in the next few weeks. And then use that information to work on your modeling. Do it early and often, particularly around the FTEs. That's something that we can help with. I feel better once we had the final rules and regulations, but certainly right now, folks only have so long to plan and to address their business needs and their staffing for this 8-week period. So we're going to move forward with the best of what we have in our interpretations and guidance. Another thought is look at how your payrolls fall. If one of your pays falls just outside of the period for the 8 weeks and that you won't meet the incurred and paid criteria, if it remains relevant, you may want to look to accelerate a payroll. Take some action to make sure that you're getting as much credit as you can for forgiveness. It goes without saying, gathering the documentation to support the forgiveness calculations, keeping that somewhere well organized and available. And then think about your plan for repayment if you're not going to have full forgiveness. This does convert back to a loan. Are you going to repay it all at once? Are you going to take it out and repay it over the 2-year period? And just make sure that your cash flow models provides that there may be some repayment required along the way. So if we go to the next slide, this is just a couple of the mechanics on what this is going to look like based on what we know now in terms of the actual forgiveness. So once the information to calculate forgiveness is provided to the lender, our understanding is that they will have 60 days to make a determination on the forgiveness. So we think about, I think Steve mentioned, or Tom, 1.6, 1.7 million loans that were processed. The banks are going to have 60 days to work through all those calculations. So I would suggest when you get yours back, look at it closely. There's going to be a lot of numbers being calculated and a lot of decisions being made. Potentials for error is pretty significant. Again, that remaining balance converts to a 2-year term loan, 1% interest. The payments are deferred for 6 months, but it is due at the end of the 2-year period. And then, we're still cautioning that lenders may differ in their request for information and the interpretation of the guidance even after the final regs are issued. We saw that on the application front, that the request for information differed drastically from institution to institution in some cases. So we suggest that you work with your lenders throughout the process so that you have a clear understanding of what they're going to want for that exercise. Interestingly, Tom mentioned the article about accounting for the guidance, and something that I've seen in some of the early documentation from banks about forgiveness is that they want to see bank statements. Really, this is the whole program. The forgiveness is based upon incurring and paying expenses, but they're asking for bank statements showing that the money is going in and the money is going out. So again, earlier we had said that we really don't think that opening a separate bank statement is necessary. Look at the wording of what your lender is asking for, and if they're asking to see bank statements to see every single transaction, you may want to think about what is the easiest way to make that happen without having to wade through and provide all the other information that's on our operating account bank statements. But hopefully with the final regulation, we'll get some real definitivity in terms of what that ask is going to be by the lenders. And with that, my last slide here is, this is all subject to change. Our hope is that the loan forgiveness final regulations, be it in the form of an FAQ or some other form of document, comes soon. Now that it seems like round 2 of the PPP funding is moving forward. But these are all the guidance based on what we know today. And so stay tuned. I think we're hopefully near the end of the book on the PPP in terms of what the rules are going to be, but we're not quite there yet. And just one final reminder, if you think about that time frame, the 60 days once the 8-week period is over to determine forgiveness. Again, I just want to reiterate Tom's mention of the deferral of the Social Security for the employer portion of payroll taxes. That's where that could still be a really nice buffer to help with cash flow in that period of time, because it could be 3 to 4 months until you get the final word on forgiveness. So, with that said, I'm going to step aside. I'm going to turn it over to Rick to talk a little bit more about some of the future view matters and the rest of the panel. So thank you, everyone.
Chad, thank you very much. Incredible amount of information that you just shared with us, and just unbelievable. And as Chad said, we're continuing to monitor this as we focus on the application. But the time is to respond and act on this now. Just for those people that are joining us for the first time this week or weren't a part of the town hall last week, we really took a look at a philosophy and a mindset that Stambaugh Ness introduced almost 2 years ago, and that is a role or a philosophy of being an anticipatory organization. And even last week, I used the term pivot. And when you think about pivot, that's more reacting than being preactive. So last week we shared with you just a number of areas that we're really encouraging people that you got to start to think about as what we're referring to as the roadmap to reentry. And it's this whole concept of being preactive and things that you can do. And actually, many of those things are going to become must-dos, as Tom mentioned. It seemed even with this PPP, those of you that participated in the webinars weeks ago, as we were talking to you, things were changing. Well, when we were talking to you last week about this roadmap to reentry, the next day you started to hear governors saying, hey, we're going to start opening up, and here are some of the criteria. So last week we talked about a number of functional areas that we really think you need to take a preactive. You got to be thinking about today, what you're going to be doing tomorrow. And one of the 6 areas that we talked about were facilities, finance. We talked about customers and contracts, reaching out to them, finding out where they are, talking to your supply chain people. Are they going to be able to provide the products and the materials, operations and personnel. But the one that we really resonated with us, because you need some lead time, is getting that environment, creating that facility so that your people, that as they are able to come back, they have that comfort and ease knowing that they're in a safe environment. And to that end, I'm going to be introducing here, and Chris on the screen right now, but Chris Baker is with Hillman Consulting, which is a well-recognized leader in the environmental consulting, risk management, loss control, and has been providing these services dating back to 1985. Interestingly, the firm originally was established in New York City, so you can only appreciate the complexities, the regulations, and the aggressiveness in those markets. And we all know that that's been a critical hot spot here with the pandemic. But it was this early experience that afforded them the unique opportunity to design protocols that would later become the foundation for the services that they've built. Hillman Consulting is strategically positioned to provide these services to the market and is working with a vast number of different owner-occupied commercial real estate across the United States. Chris, who's going to be joining me right now, is Vice President of Operations at Hillman, responsible for business operations, fiscal management, field staff management throughout the company, in excess of 30 years. And of particular interest, Chris is responsible for the performance and management of the industrial hygiene services. So with that, Chris, I'm going to turn the baton over to you. I'll be rejoining Kristi Weierbach, who will then be working with the panel on some of the other topics today of facilities, finance, and personnel and technology. So with that, Chris, I'd like to hear a little bit about what Hillman's seeing, and particularly with you located in the New York, New Jersey area. I'm sure you're having a lot of activity. So Chris, thanks for joining us today.
Thank you, Rick. I appreciate it, and Hillman appreciates the opportunity to speak to everybody. Yeah, it's a little crazy here in New York City. Like most people, we've been reactive. When the pandemic began, we spent a lot of time with clients, helping them react. How do I clean my building? I just had an infected person come in. What do I do? And a lot of our work was reactive in nature. And it's funny you mentioned pivot, because really in the last 2 weeks, just talking to our clients, they're ready to pivot to how do I reopen, and what does that look like, and what does that mean? And some of our buildings have been completely closed. Some of them have been operating very lightly. Some of them have been close to normal occupancy. Honestly, it just depends on the tenant and the client we're working with. But the majority is on slim to no staff. And so we see, as we pivot to get on top of this and move in front, there's 3 main things we all want to think about, is getting our facility, whether it's our suite or office building, ready for people to come back, and making them feel confident that it's safe to do so. When they start coming back, is making sure we clean. We're going to be living with COVID until there's a vaccine. So if we come back to our offices, what does that look like when we've been told now for months to social distance and to wear a face covering? And how do we do that when I have a cube farm out here that I work in? So how do we clean properly moving forward? And the third part, which is there's not a lot of guidance out there, and it forces us to be creative, which is kind of fun, frankly, is creating social distancing guidelines for reoccupying our buildings. So I'm going to kind of go through each of those 3 briefly. And I want you to start thinking about these things, because we do need to start thinking now about them. I just got off the phone with a mall owner client who South Carolina is going to let them reopen on Saturday, which seems a bit fast to me, but that's what they're dealing with, and time is money, so they're pushing to reopen. So we're trying to help them get through that. So I'll start with getting your facility ready to reopen right now. The first thing that we recommend you do is to actually go through your facility, to get out there as soon as possible to walk through. Hopefully you've kept some kind of ventilation going. Buildings that tend to have no ventilation can have humidity issues. Humidity causes condensation and potential mold growth. So you want to walk through the interior of your space, taking a look at things like potential mold growth on furniture, particularly fabrics. Have there been any water releases? Go through kitchens, go through slop sink areas, janitorial areas. Make sure you haven't had any water issues. Make sure the garbage has been picked up. Something as simple as somebody leaving their lunch in their desk can lead to odor issues that nobody can understand until that employee goes through a desk. So getting on top of it, look for that. Vermin issues. If there's been nobody there, the mice tend to take over. So you want to get in there and look at it. Look for things like floor drains and sinks. Make sure the water traps are full. If they evaporate and dry out, you're going to start getting sewer odors in the building. So that's something very simple you can start doing. And honestly, you want to be doing that kind of on a weekly basis if you can. The HVAC system is obviously key. It supplies us with fresh, clean air. So you want to have your mechanical contractor come in and do an inspection of the interior, change out my filters, upgrade my filters, and moving forward, one of the things CDC points out is having increased filtration capacity. So, a lot of people put in the nice cheap filters, which don't really do much for you, frankly. They just keep the dust off the coils, which is good, but we want to protect the occupants too, right? So we want to increase filtration to MERV levels 13. I know most of you probably don't know what that means. Your contractor will. And not every air handler can do that, but that's something you want to consider. We do want to increase the outside air, especially if you've been running on a limited basis or not at all. We want to put the system back on normal. We want to start purging the building with fresh air. So one, it'll smell better. And something a lot of people haven't considered is, over the years we've gone to these green cleaning chemicals that aren't as harsh. But we've had to switch to chemicals that can clean a virus. And those chemicals are not green chemicals. And so a lot of them have odors. A lot of them are not what we're used to. So there's going to be a lingering odor problem within a space. And so we want to increase the outside air in our mechanical system so that we can move that odor along. We have a saying, the solution to pollution is dilution. Well, in this case, we want to dilute with fresh air. As part of air handling systems, you want to make sure your exhaust systems are operational. Make sure the bathroom exhaust systems are still operating, that a bird hasn't put a nest in it and started blocking it up, that our garages, if you're in a building with subgrade parking garages, make sure the exhaust fans are operational and that they're on, that they haven't been de-energized to save money. Well, now with the staff coming back, we need to make sure they're working. Obviously, kitchens, restaurants, cafeterias, make sure their filtration systems are on and operational so that we don't have a problem there. And then the third thing, and CDC has really made a big push on this, is your domestic water system. If water's sitting in pipes for a long time, it's going to lead to bacterial issues. So, you're going to say, Chris, I get my water from the city, they chlorinate it or disinfect it in whatever system they use. That's true, but water sitting stagnant will naturally off-gas that chlorine. And so the water loses the ability to fight off a bacterial infection. And there is, frankly, natural occurring bacteria in our water. So if we lose the chlorinization, you can start to get bacteria growth, particularly Legionella. So we want to go through our buildings now and start flushing them and flushing them well. We want to replace the building that's sitting in all the water sitting in the pipes of our building so that we have fresh water in. Hot water heaters are extremely important. Warm water tends to lead to more bacteria. So we want to make sure the water that's been sitting in hot water heaters gets replaced. You want to do that now if we're opening within the next couple of weeks, even within the next month. flush it now, and then have maybe every 2 weeks do a flush until people start coming back. But that is really a big health concern, that stagnant water has been sitting there. If you have a gym, in the basement of your building, all those hot water shower heads, all that needs to be flushed thoroughly before people start using it again. So that's the basics of getting your building ready. Cleaning. So a lot of us had already switched to more what we call enhanced cleaning more often. If you're in a building with a central lobby and elevator system, we have started cleaning that much more often. And we're going to have to continue that, right? Because we don't know. I might be carrying the disease. I don't even know that. We're going to have a lot of people coming back in various stages that we don't even know. So we're going to have to keep cleaning high-touch surfaces, elevator buttons, door handles. Anything people are touching, we're going to have to keep cleaning so that somebody else doesn't come along and touch that and maybe pick up the virus. So this enhanced cleaning is going to continue. One of the early issues we found were people not using proper chemicals for the cleaning. And if you're not sure, I would tell you to look for the EPA ID number that should be on the label of the bottle that you're getting your chemical from. Google EPA list N as in Nancy, and then there's a spot you can put that EPA number in, and if that chemical shows up on that list, then it's appropriate for COVID work. And I would just warn you that the name that comes up on the EPA list is going to probably be the primary ingredient that fights the virus. It won't come up as Clorox 360 because that's a trade name. It just comes up. As long as that EPA ID number shows up in list N, you're good to go. That's what you can use. And we're going to have to start thinking about within our tenant spaces having disinfection wipes available for our staff to use. Internally, things like copiers, scanners are central points that multiple people are using. So we're going to need to keep cleaning those surfaces all the time, just between our own staff using it. And we're going to want to put hand sanitation stations out so that people can sanitize their hands routinely. Obviously, we want to encourage hand washing as much as possible. I know the state of Pennsylvania is requiring hourly hand washing. I'm not really sure how you enforce that other than maybe signage, making sure supervisors are aware and remind staff to go out and wash their hands hourly. But it really is an effective control to help stop the spread. And then the third thing that you need to get creative and start thinking about is how do I social distance in my workplace? What does that even mean? So the first thing we want to always start with is tell our staff if you're sick, stay home. If your spouse or somebody living with you is sick, please stay home. Don't introduce that to our workplace. So that's always going to be our primary. We should be requiring face masks, and I'm sure different states are going to have different levels of requirements on that, so it's something to keep an eye out for. But we think that's a good basic practice. We're going to have a direct flow in and out of our building. What we're trying to prevent or what we want to encourage is the 6-foot social distancing. So maybe we use one set of doors to enter and one set of doors to exit. If we have turnstiles in a building, the same thing. Creating an exit line for the elevator and maybe a wait station for the elevator so people can get off before the next crew get on the elevator. How many people could be on an elevator? Your average elevator is like 5x5. So, excuse me. So you're going to have to think that if you're a building manager, how many people are allowed in this elevator? You want to identify choke points. Where do a lot of people come together at one time? And come up with a strategy to limit that. We don't want a lot of people coming in the same way. Maybe your space has a main entrance, but there's exits off on the corridor. So maybe you can make the main entrance an entrance only and tell people that they have to flow through the hallway entrances as an exit. So that way you don't have people back and forth crossing each other. You have to do what I've heard some architects call de-densify. Less people in a given space. Maybe you've got 3 people, in a 200 square foot office area. That's not quite enough space to keep 6 feet between them. So maybe you make that only a 2-person or 1-person office. Maybe you stagger your shift times, or when you had different departments come in, so you don't have everybody showing up for 8 o'clock start time, but maybe you do 7:30, 8:30, so you don't have as much of a crowd, which then lends itself to lunchtime, staggering it. Because typically we all, people kind of come in whenever they need and want to come in, but we all take lunch between 11:30 and 1. We can't have that many people coming in and out at the same time. So by staggering start times, then we want to stagger lunch times. Again, just to work on crowd control and have less people coming through. Conference rooms, we really got to limit the number of people in the conference room. Maybe continue doing things. I know we're all getting a little tired of Zoom and webinars like this, but maybe you need to keep doing that just so you don't have everybody in a conference room at the same time. And when you do have to do it, remove every other chair. Space out. My wife works for the Corps of Engineers, and the Army has set up a rule where literally they measure 6 feet between each chair, and they have no more than, I believe, 6 is the most they even allow in a conference room. So even an organization that large is really struggling with this, but that's the kind of rules you have to look at, because you could wipe out the entire accounting department if somebody sick is in that conference room with you. So other things you could think of, a lot of us hotel workstations where we have staff use it for a couple of days a week. That we got to be really careful with that, right? Because these people are working somewhere else and coming in, and they're sharing a telephone. Like this is the dirtiest part of your day here, this telephone. And how often does it really get clean? Well, now,
Chris, I think you turned your sound off when you hung up your receiver. We can't hear you. Sorry about that, everyone. Just hold on 1 second as we have the ability to get Chris's voice back. So one of the things that we will be talking about once we get Chris back, we will shift the conversation to actually talk about employees that resist. So there is definitely the potential, as employees are scared or fearful, that they will maybe not want to come back in or want to ensure that you're taking all the proper steps and so forth. I still can't hear you, Chris.
I'm sorry, but the phone I hung up on it, didn't I?
Okay. You're
I'm
good.
sorry
Go
about
ahead.
that, folks. So I was almost done. What did I talk about the phone? Oh, yeah, hoteling. So on hoteling, we also have to make sure that we clean things like keyboards and mouses, anything we share. We really want to try to eliminate that if at all possible, the sharing of stuff, because you just don't know who's got it or had it, and we don't want to pass that along. We want to limit deliveries to only necessary deliveries. I am guilty of sending my Amazon packages to the office, but we really want to try to limit that moving forward. Visitors, we want to eliminate visitors to the extent that we can, just because we don't want to bring in an outside, person into our office at all possible. And then the last thing I would say is consider the exterior. Now the weather's getting nice. People are going to eat outside. Restaurants are still closed, at least at the moment. So they got nowhere to go for lunch, and people will tend to congregate outside. So you want to make sure you put maybe signage up, remind people to do 6-foot distancing, and that's pretty much it. I mean, there's a lot to think of there. That's what we're struggling to work with clients on, so that they're operational and hopefully keep people safe as possible.
Chris, again, just thank you very much, for joining us today. And if you can stay on, I know you've been through the first session. I'm sure you have other things to do, but I would just encourage any of the participants on the webinar, if you have questions, Kaylee will be monitoring those, and she can maybe, pass those on to Kristi here. Kristi's going to pick up as the moderator of some of the other key functional areas that we're going to be talking about, particularly the finance operations and the personnel. So with that, Kristi, I'm going to pass it over to you.
Kristi, you're muted.
Oh, well, I did it too now. Sorry, everyone. Thank you, Tom. So as we're getting everybody up here on the screen, Chris, I want to thank you so much for all the tips and tricks that you provided. Really good sound advice for people to think about that maybe they haven't thought about yet. And so while everybody's joining us, I just have one quick question for you, Chris. From an OSHA standpoint, is there anything else we need to be thinking about? I know a lot of what you had said falls in line with OSHA guidelines and requirements, but is there anything else we need to be thinking
about? So the good thing is OSHA is kind of, at first that it's a reportable incident if somebody gets sick, but given that we can really track exactly where somebody was exposed, they've backed off that now. Which is good for particularly folks like me, where we have people running around all the time. But other than that, I mean, the one thing I would let you know is that on respirators, N95 respirators, which they really don't want us to use in the general public because we want to save that for nurses and first responders. But if you did get hold of some, an N95 is a regulated respirator. It's actually fit tested. And for OSHA, that means you have to have a respiratory protection program. Wearing a fit test, a tight fitting respirator like that put extra strain on your lungs and your heart. And so OSHA has set up a whole standard on people who are allowed to wear that. So as an employer, you can't hand those out unless you have a medical surveillance program, a respiratory protection program, and we know it's safe for somebody to actually use that respirator. So I know there's limitations to face masks. I'm sure you've all seen that, but that's really the way you have to go unless, frankly, you're a professional like we are, where our staff has to do that as part of their job duties.
Great, thank you.
Sure.
So Katie, I'm going to ask you to jump in here next and talk a little bit about employees that are possibly going to resist wanting to come back to work.
Sure. I know that that's something that I think a lot of you probably are thinking about, and maybe you've been in that situation where, somebody is just literally terrified. And as we know, all of us are having different levels of stress and anxiety as it is. Governor Wolf obviously mandated some masks recently, and of course what Chris was talking about. So what do you do in that situation? I would say off the top of my head, it would be a case-by-case situation. Obviously, you don't want somebody to come to work and they're absolutely terrified. The ripple effect on that, I think, would just go the wrong way. If there's different ways that we can work with people, maybe there's some type of compromise, but I get a little nervous when, you have somebody who has gone on record and told you, I am really nervous about this, and I don't trust that other employees are taking care of themselves. How do I know where they are? And you could just see how the questions will start to shape and mold that way. Kristi, have you been in that situation yet when you've been working with your clients where maybe some people have come forward and asked you that?
Yeah, absolutely. There are employees already that are refusing to come back, and I know, or I can understand why they would feel that way. So it's important that we as a company talk about the measures we're taking to help protect them and ensure their safety. And just because they choose to stay home doesn't mean they're eligible for unemployment necessarily. So it also could put a burden on you and your organization from just a work standpoint, being able to have enough people in each position. And so you might have to look to hire. So I echo Katie's comment that it is case by case, situation by situation. Are there other factors that need to be considered, other underlying health conditions of not only the person who's afraid, but also maybe the people they work directly with? So it is a tangled web for sure, but there are options, there are choices, and not every situation has to be a blanketed, just accommodate everybody in all the same way. So just know that there are resources and help for you out there. So Phil, I'm going to switch it over to you. We're going to change subject slightly. want to talk about technology. So we hear about the infamous Zoom calls that are occurring and people dropping in naked or in other inappropriate ways. So what security and privacy concerns should we be evaluating as we plan on establishing a remote workforce post-COVID-19, thinking about the electronic technologies and cybersecurity and so forth?
Yeah, and the question that I've been getting asked more frequently over the course of the past few weeks is, what security and privacy concerns should we be evaluating as we plan on establishing a portion of our employees remote? And then also, what does that look like? How do bringing them back in? Just like Chris had mentioned, and even Katie there too, with the distancing piece of this, and 6 feet away, people that have cubicles or offices, are they going to have to be repositioned? Which at the end of the day, then that means repositioning the technology component. So when you take a look at the security piece of this and having people stay at home and continue that remote workforce, you need to ensure, first and foremost, that you have a secure link from the employee's home network back to the corporate VPN if they're retrieving information or data from on-premise servers. In recent conversations with businesses regarding aging technology, they're actually evaluating now. It was everybody was at the pushing to move cloud, go to SaaS products, but at the time, everybody had core infrastructure on-prem environments still running and functioning fine until now, where they don't have the bandwidth, the CPU and the resources available with those on-premise networks. And now people tunneling in through VPN, it's a bottleneck. People are sitting there waiting. They're little circles spinning for could be 15, 20, 30 seconds. When you think in your back of your mind, man, that's not really that long. But if you're the person on the backside of that, sitting there waiting 15 to 20 to 30 seconds for something to load, it is frustrating. So with this COVID-19, it's really ramping forward and having people evaluate cloud-based solutions now where you don't have to worry about infrastructure if something like this happens again. And I'm telling you right now, based upon what I'm hearing, I don't know that COVID-19, the pandemic may subside, but who knows how long the virus is going to be around? Who knows how long we may be at more of a kind of disclosed environment, staying at home more, not quite going out as often as we used to. So having networks available that are scalable, where you can spin them up, spin them down, that whole cloud methodology is a lot more appealing at the moment. And when you look at the cybersecurity piece of this as well, 4 questions you should be asking yourself before deploying remote workers. What is the user's job? What is the user's job function? And what access do they need? Don't just go into this and think, unrestricted access. Think of provide the least amount of access to those employees that's needed for them to function, and then release access as needed for them to be able to continue to work. And then, of course, there are some users that are going to require more bandwidth, computing power on devices. These are all things that people are now coming to me about. It's like, hey, we have users that VPNs dropping at home. Why is that happening? It's a lot. There's a culmination of things, but a lot of it comes down to what's the home network look like. Do they have something that's not very powerful? They may have a small megabits per second upload and download and upload speed, which is certainly going to impact VPN. If you look at deploying remote workers, companies need to address that. And then the second one, who owns the hardware, and how is your business going to track that? Ultimately, you have to have a way of tracking the inventory that you're deploying. Thirdly, what kind of data and applications does the employee need access to? And then lastly, from a privacy perspective, where is the user located? I don't know how many people on the call here have people that are across the country that may have to adhere to GDPR regulations, but as we look at data security, labor, and privacy laws, not all are the same across countries, state, or local authorities. So it's going to create an issue for employees that are now working from home across the region. So make sure as the employer, you're understanding where the data is being stored and who has access to what.
Great. Thank you, Phil. Appreciate the helpful hints and suggestions. And Darren, I'm changing it over to you next. As we think about the next 30 days and beyond, we've heard that COVID is not going away. We know this is going to continue to impact our organization. So from a cash flow perspective, are there any additional adjustments to the tools that people use to help them through this, and or what are some of the disruptors that you're thinking might impact businesses that they're not thinking about in the moment? You're mute. Your microphone's not working, Darren.
All right. I'm on now?
There you go. Yeah.
All right. My mistake. Apologize. What I started to say there was I think we started to introduce some of these ideas last week when we were talking about reviewing assessing your customers and your supply chain. And I'm thinking about this in terms of working from the outside in. So in other words, start by assessing your vendors and customers, gathering information, and then filtering that into your internal budgeting, forecasting, and cash flow mechanisms. So for example, as it relates to customers, you probably want to start monitoring backlogs very closely, order activity that's coming in, project status, and at the back end on collections. And then likewise with your vendors, start to take a look at material and inventory status, delivery schedules, and then start to coordinate and match that all up with the impact that it has on your schedules, both either from a production standpoint or scheduling projects out. And that all then feeds into how you're managing your resources, whether it's equipment or labor. So I think that's how I'm looking at kind of the information gathering process. And then once you've got all of that information collected, then I think you want to move into what I mentioned earlier, is really kind of going back. And I think a lot of companies might be in a place where they need to take a serious look at their budget and either revise it, update it, or even just start over, depending on where you're at and the impact that this situation is having on the business. So my suggestion is when you're looking at your budget, focus on your fixed costs, because variable costs should, in theory at least, vary as your revenue volume varies. So focus on the fixed costs. One thing I recommend is that companies, as you evaluate those fixed costs, start to identify and maybe put them into different buckets. So think about, of those costs, what can be reduced, suspended, or eliminated. And that's not to say that you're going to necessarily take those actions immediately, but at least maybe you have a plan in place so that, because I don't want to lose sight of the fact that we're seeing a pretty broad range of impact. So I've talked to companies that are basically fully operational, and then we know we have other companies that are essentially shut down. So depending on where you're at in that spectrum of impact, I think this exercise is valuable for almost anybody, because even if you're not feeling significant impact right now, you've at least established a game plan so that if and when you start to see some indicators that things are slowing down a little bit, you've identified some of the actions that you're going to take when that or if that happens. So that's why I think, again, regardless of where you're at with this, it's a good idea to start to identify and establish some of those plans. And then further, I guess this is a little bit along the lines of what I was just describing is, once you've done that assessment, now you can start to go through some what if scenarios. So again, depending on where you're at, you could say, well, what if our collections start to decline 10%, 20%? What if, we start to see backlogs decline? What if we have a supply chain disruption? Things like that. And you start to build those into your models and get an understanding of what the impact will be. And lastly, I think ultimately, we need to remember that in times like this, cash is king. And so I've talked about budgeting, but we also need to talk about cash flow. And the budget kind of naturally flows into cash flow forecasting. But you still need to, you need to importantly understand the cash flow cycle for your individual business. So you need to understand lead times for materials. You need to understand payment terms with your vendors, production cycles, collection cycles, all of those things that ultimately lead to and factor into your cash flow cycle. So those are some of the things that I suggest to clients that they take into consideration in terms of cash flow management.
Thank you, Darren. So we are coming up on the 4 o'clock hour, and we more than likely will not be able to address the questions that came in through the Q&A. So we as a team will be addressing those in the coming days, and we'll absolutely make those available so everybody can see them. I do have one question that came in from Susan for Chris. I'm going to let him answer that. Then Tom, I'm going to kick it over to you to talk a little bit about the R&D tax credit because you did tease everybody at the beginning of your session, and then I'll let you take us home and close out the hour. So Chris, Susan wants to know, they are on the second floor of a building without any way of allowing fresh air. None of the windows open. So what do you suggest?
Well, fresh air is introduced through the mechanical unit. So it's probably, the machine probably regulates based on temperature how much it'll open the outside air damper. But that's where generally in an office environment, you're getting your fresh air from. It's coming through the air handling system. And it'll move depending on the temperature for anywhere from 5% to 20% open. So at this point, CDC, and we're recommending, we try to keep a 20% airflow as much as possible. When it gets hot and humid in the summer, you're gonna have to tune it down a little bit. But that's really where your airflow is coming from.
Great, thank you so much. Thank you to all of my peers here on the round table. As always, I greatly appreciate your insight and wisdom. So Tom, do you want to take us home?
Sure. So hello again, everyone. A lot of information today. My webcam's a little slow to react here. There we go. It was that spinning circle that Phil was talking about there for a bit. But yeah, I talked a little bit about the R&D tax credit in my opening remarks as maybe a rear view mirror type of thing, looking back at activities that you've done in the past and what qualifies. But remember, the R&D tax credit, and I think a lot of people have a misconception that the R&D tax credit is only for bringing some revolutionary new product to the market, whether that's a technology or a pharmaceutical or whatnot. But it's really all about making your operation more efficient or better. It certainly could be a new product that you're developing, but it could just be a more efficient way of doing things. And as we listen to Chris speak, as we listen to Phil speak, as we listen to Darren speak, I think the reality is that we're all going to have to do things differently as we move back into our offices. Whether that qualifies for the R&D tax credit or not is dependent upon how technological in nature that is. But think about it. To accommodate our remote workforce, we're doing all kinds of things that are technical. We may put new manufacturing processes in place. We may even be developing new products to respond to the new market needs. So as you do those things, certainly think about it. Talk to us. Well, it will give you a good assessment as to whether those activities qualify, because you're certainly going to be spending a lot of dollars, and it's going to fall into those cash flow projections and such that Darren talked about. So this may be a way to help finance that. So we certainly don't want to let that slip by the wayside. So anyway, we are at the end of our time here today. It was a very, very full agenda. We apologize for not getting to the Q&A live, but we certainly will answer each and every one of your questions. Please submit them through the survey that you'll be sent, and we will get an email out as soon as we can get through all those questions to everyone to give you your answers, and you'll be able to see the answers to the other questions as well. Want to give a special thanks again to Chris Baker for joining us today. It was very, very informative. I think that's information almost each and every one of us can use in our businesses as we get back on premise. Also, obviously, want to thank all of our other Stambaugh Ness presenters. They all do a great job every week. They spend an awful lot of time all week long staying on top of all of this so they can bring you the latest information. And again, we want to thank all of you for joining us. We hope we see you again next week, April 28th at 2 p.m. Eastern. And in the meantime, please feel free to reach out to us at any time. So everyone have a great week, and everyone stay safe, and we'll soon be through this. Thank you.